The IRS recently dropped Revenue Procedure 2024-28, a game changer for how you allocate the basis of your digital assets, how you report on your crypto tax activities, and it's effective January 2025. So is this another crypto tax curveball? What does it mean for you as an individual or for your crypto company? Will this new safe harbor simplify your tax reporting or just add another layer of complexity? From FIFO, wallet-specific rules, we'll break it all down with examples, tips, and expert insights. So grab your headphones, buckle up. This session could definitely save you from significant pain and IRS penalties. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, if you enjoy this content, make sure to like and subscribe for more top-tier insights from industry experts who have been around the block. I'm Noah Buxton, and I'm here with Nick Ward from the network firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. What's up, Nick?
Hey, Noah. Good morning.
Good morning. Did you have enough coffee yet?
I'm good, yeah.
All right.
Probably good to have a couple extra cups for this one for our listeners.
Exactly. Don't shy away, folks. I know it's tax. You don't necessarily want to hear about it. But this one, it's impending, right? We've got this January 2025 implementation for this safe harbor, and we really want to break this down for you. We're going to try and make it relatively simple, give you a lot of background so that you can really start to understand this. And it won't be that complicated, I think, once we work through this.
For sure.
Yeah.
I'm curious, like jumping right in. This was passed in 24, right? We've got a new administration coming in. Does this even matter?
Yeah, great question. So I feel like, this is kind of the thought process in the industry right now is we know that a bunch of doors are going to kick down, a bunch of hurdles are going to be knocked over, but we're not sure exactly which ones and in what priority and how long it'll take. But what I would say for this is that the IRS, Revenue Procedure 2024-28, right? This is an IRS rule, essentially. It's an administrative procedure. And IRS, has put this out in an attempt to clarify tax reporting rules for individuals and companies, and also to align with a prior procedure. And we'll talk about the interconnection between those two. But because it's an administrative rule thing, these are typically the types of things that in a change of administration get a little less attention, right, than laws and other formal regulations. So I think, this is probably likely to stay in effect or continue for at least some period of time. It certainly won't be the first thing I don't believe that the Trump administration gets to.
Okay, great. Yeah, good to know. And then maybe before we dive in, I know you and our tax side have been hard at work on one of our newer reports for the year. Maybe talk about that briefly and let people know where they could find it, and then we can really...
Awesome. Yeah. We just minted the final version, I guess it's been a couple weeks ago now, of the DGens Digest, the 2024 edition. So this is, TNF's go-to guide for navigating the crypto tax maze. And it's a really comprehensive document, but it's laid out in a way to be simple and for users to understand. So what are the big tax reminders, and then so what are the best practices for maintaining the right records and documentation, and then sort of what are some of the potential arguable gray areas, right? What are specific types of transactions that you might engage in that could be, again, there's some gray area, right? There's not a clear rule saying thou shalt treat this a certain way, so it gives you some flexibility. And we're happy to make that available to, of course, existing clients get a copy, but anybody else can have one as well. So check the link in the description below, and we'll link to a web form there. You can just request a copy of your DGens Digest.
Okay, awesome. Yeah, definitely recommend pulling that down. I know I get questions all the time about taxes, and this will be a good buffer for our listeners to start to think about or get some answers. And then obviously they can always reach out.
Nice. All right. So will you set the framework for us? We talked a little bit before this about sort of all the things we want to cover, and there's quite a few. So maybe give our listeners like the bullet points here. What are the buckets that we're going to cover.
Yeah, I think the goal today, we'll talk about kind of the historical stage, when the IRS first set rules for crypto in general, what that meant. We'll talk about the new regulations that you teased at the top. And we'll talk about some of the compliance burdens that are going to come with that, and a good reason you want to be listening to this and getting ahead. And then, we'll talk a little back and forth on what our perspective is and the best thing or potential pushback we may see from the industry or just crypto users.
Awesome.
So maybe kicking off, let's break down what this new rule really means and some of the key points of it that people are going to want.
Okay. In a nutshell, it means that if you've reported your crypto taxes in the past on a universal sort of disposition or across wallets and accounts, for instance, you're using a FIFO, you're using an online a crypto tax software, and there's the universal button is checked. It means it's going to apply first in, first out, but it's not going to respect wallets or accounts, meaning specific on-chain wallets or accounts, sort of being like centralized exchange providers. It's just going to apply first in, first out across everything. This rule says no longer. It will be basis and dispositions will be tracked by wallet and by account. So you can kind of think of it going from one unified ledger of all your activity to individual ledgers by account is one way to think about it.
Okay, great. Yeah, maybe just to ultra simplify it, I was lucky enough to be maybe mining Bitcoin back in the day. I've kept that on cold storage. Since then, maybe took advantage of, say, River with the direct cost average, no fees. Previously, when I went to maybe liquidate a little bit, I'm looking at, hey, all my Bitcoin starting back in 14 is where my cost basis begins, opposed to now I can set those kind of walls and say, I've got my River account, which is newer. I'll use that more recent cost basis and leave the cold storage alone, and I don't have to worry.
Exactly. Yep. That's a great example. That's a great example. So you would have, in IRS's terms, you'd have unused basis, right, in your old Bitcoin, your mined Bitcoin in cold storage. You'd also have unused basis in your River account. In this case, sounds like you sold a little bit. Not diamond hands, Nick. Not very diamond hands of you. All good.
A lot of mouths to feed over here.
Exactly. I'm guilty of the same. So yeah, you'd have unused basis, right, in these two accounts. And the other thing that this rule does is set this safe harbor, right? So it says that as of January 1st, 2025, if the taxpayer goes through the exercise of ensuring they've allocated the unused basis by wallet and account, then they're set up essentially for safe harbor, which we should explain what that means. It's kind of an IRS term. But yeah, that January sets that deadline. So you need to go through this exercise arguably before January. So it really just, within the month here. And then certainly before you file taxes. And we can talk about, before you file your 2025 taxes in early 26.
Okay. No, it's good to know. And maybe backing up a minute, right? Because this rule clarified things. It wasn't that the IRS was very clear before either that you couldn't do this. So maybe give us a little bit of how we got here. I think the first ruling where the IRS even acknowledged crypto was back in 2014, and I think they called it virtual currency. So maybe give us a little bit of that.
Yeah, and jump in and help me out here too, because I know you've done a lot of this. You're very early in this space. So yeah, I think generally speaking, the background here is right. The IRS, I think, has been doing maybe a little bit too little in terms of clarity and a little bit too late is kind of how I think of it. But 2014, the IRS took an FAQs approach, so frequently asked questions, and laid out some guidance and in those FAQs, which there's a 2014 version. I think they've updated in 2019 as well. This really outlines how taxpayers can calculate cost basis of digital assets. The 2019 version is about hard forks and staking income, or airdrop income, excuse me. And so yeah, I think the other thing from 2014 is really right. Crypto is treated as property, so not analogizing it to securities, but the way you essentially track and report on tax for crypto is like you would with stocks and bonds.
Yep, essentially the same. Yeah, you apply your cost basis, fair market value at the time you liquidate or spend it, and there's your gain loss that they're going to tax. Yeah, and I
Exactly.
always laugh at the 2019 ruling because I remember I got asked to do some presentations to CPA firms at the time. They said, "Hey, there's this new crypto ruling," and I'm like, "Yeah, it's great. It's a new letter, but it deals with airdrops and hard forks," which I remember explaining to the audience and getting a lot of blank stares at the time. And frankly, you'd probably even still get a lot of those blank stares today. That's
Yeah.
definitely a technical layer or two deep within the space.
Well, and the other side of that too is, being in this space for quite a while. When that came out, when did uh, when did Bitcoin, uh, the Bitcoin Cash fork happen? Was that 2017, early 2017 or so?
Yeah, 2017 or 18 at the latest.
Yeah, yeah. And I remember thinking when this the 2019 hard fork thing came out, I remember thinking, okay, cool. Like, thanks a lot. Again, too little, too late. We'd already treated it that way. We'd already made the analogy. We'd worked with clients to say, gosh, you really, if you do actually have access to Bitcoin and you now have access to an equivalent count of Bitcoin Cash, you've received income, like you've received property income. And it just, that was a conservative approach, but like we'd already done that with clients. So it was like 2 years later, they're telling us something that was pretty obvious, I thought. So in any
Yeah, for
case, not,
sure.
yeah. Yeah, not to bag on the IRS too much. I think it's a steep hill to climb in terms of figuring out the right approach for crypto. And but anyway, yeah, back to this new rule. Again, it's really focused on wallet by wallet and account by account versus universally tracking across all wallets and accounts. And that might be really simple for some taxpayers. It might be, well, I've only got a few on-chain wallets, across a couple networks, and I've got a Coinbase account, right? And so that's a pretty simple case. Unfortunately, most of the clients we deal with, it's more like 50 wallets or more, right? And then a handful of exchanges. So there's the other thing for background is like there's a little bit bigger context here, and this the rule, like just trying to getting folks to understand like the purpose and the interconnection here, I think helps really understand wallet by wallet and why they're doing that. So let's talk about that a little bit. The June 2024 regs specific to broker dealers.
Yeah, no,
So go for it. Yeah, if you want to.
yeah, the broker dealer rule, and maybe I back up 1 second. I always get the question, well, how does the IRS know, right? Or how do they track this and all that? And it's like, well, most of us are going through an exchange at some point. Um, you know, generally need it to convert fiat into crypto, and then maybe you move on completely on chain. But for the most part, you're going in and out of an exchange, and that was one of the key things with the broker dealer rule is now they've got this 1099 DA report that's going to start to be produced. And so that was, I think, in June of 24. So now this 1099 DA will require all those exchanges and centralized parties to establish this 1099 DA form, which will report digital asset transactions, gross proceeds. It even will require them to report the gain loss. So my guess is in the next few months, right, you're going to log on and see these exchanges start to ask you, what is the cost basis here if you had not purchased on their exchange and they're unaware of it. So maybe you took some of that, if you mined Bitcoin or you staked ETH on your own nodes and you brought it to the exchange, they're going to be asking those questions. And this is
Yeah, that's exactly right. It's good for folks to anticipate. So I think, yeah, beginning in 2025. So for the 25 tax year, they're going to have to report proceeds, right? So your example, you sold a little bit of Bitcoin on River. River is going to have a 1099 DA sent to your address or available in your account that you can download, and it's going to say you sold X number of dollars worth, right? You received this much dollar proceeds from sales. But like you said, they don't know the basis. They might not know the basis, right? In your example, let's say you mined that old Bitcoin and you deposited some of it to River and then sold it. River has no idea what the capital gain or loss was, right? It just knows that you were able to sell Bitcoin for X dollars and withdraw it. And so in 26, they're actually 2026 reporting the 1099 DA will require firms to provide that basis and capital gain information or income information, even from like staking as a service. So yeah, I would expect this deposit workflow to change, right? I'm depositing to the exchange, select the address. It's going to be like, identify the basis. It's a really difficult problem to solve because, yeah, you can have sort of a good faith, the taxpayer marks the basis. I don't know how else you would solve it. Yeah, it's going to be.
It's going to be extra questions and, frankly, a larger burden on the exchanges themselves. Because they're going to have to start to track that, make sure they're complying. And this applies to individuals and businesses, correct? So both sides can expect to start to receive these forms.
That's exactly right. Yeah. The rule that we're talking about today, the Revenue Procedure 2024-28, just by wallet accounting, definitely applies to both types of taxpayers, corporates or individuals. And on this 1099 DA thing, there's, I think, kind of two other important points. You said you get this question, and I get it too, about, well, how are they going to know? Or I've, frankly, even heard folks say, gosh, if I can barely figure it out, it's this complex, like how's IRS ever going to figure it out? Well, I just want to disabuse people of that notion, because really what happens is if you get pulled for audit, it's a pretty uncomfortable experience, right? That we've worked clients through. It's not that IRS has to figure it out and then litigate with you about it. It's you have to show IRS that you've kept all the sufficient records and documents to show that you complied with the tax rules as they were. And now there might be litigation around a tax treatment here and there, but that's it's really up to the taxpayer to produce all the documents. And so, yeah, don't think that IRS has to also figure it out, right?
Yep.
Yeah,
burden of proof's on the taxpayer. Even when you use a CPA to file your taxes, right? Like they're going to do a general sniff test and make sure it's not blatantly, incorrect. But at the end of the day, they're not auditing your return. They're just taking your data and helping you file. So
exactly. They just have to have a reasonable basis to believe it's true and correct of what's in there, right?
Yeah.
To sign
and
off
frankly,
on that.
That's why you want to work with CPAs that know what they're doing here, because they're going to prepare those records and make sure you're doing that in the event of an audit, which, again, hopefully doesn't come. But if it does, you definitely want to be prepared for it.
Yeah. I promise I didn't plan to plug our services here, but in this point, but it comes. So this is really on point. So we actually don't sign tax returns at the network firm today. We don't sign them because we're hyper focused on actually the much more complicated part, which is doing the proper tax basis tracking, addressing and documenting the gray areas and positions that the client's taken, and creating a really robust set of records so that you can rest easy once you've filed those tax returns. And this includes some things that go over and above. Frankly, very few tax CPAs really know the space well enough to actually do that level of the data work. But on top of that, we sign off on it too. Like we put our reputation on the line by a full memo for the client that says, here's everything that we did. Here's what the software did automatically. Here's what we adjusted. Here's why we adjusted it. Here's the supporting documentation. And it's a really important record for the client. Because again, like you said, burden of proof is on the client to show that they did the right thing.
Yeah. No, that's good stuff. I think, I always have to check myself talking taxes because, we are conversing with ourselves a lot of time during the week, or even our clients that are, caught up to speed. They're aware of what they need to be doing, but we've been throwing a lot of terms around, right? Basis, unhosted wallets, which I think is a funny way the IRS says self-custody wallets. Maybe talk about a few of these just so our users are well aware, dropping this lingo in and out.
For sure. Yeah, one of them is safe harbor too. I think we've said, this provides this January of safe harbor. What does that mean? It means that you essentially get, let's say, a protection from penalties. So a good example is the underpayment penalty, right? So if you've underpaid taxes for a year, there's potentially a penalty, right? Which is a penalty plus interest accrued on the tax that wasn't paid that should have been. But there's a safe harbor there, which means if you pay 90%, I believe, of the current year's tax estimated, and most people don't have to deal with this because they're W-2 and they're withholding, right? And it's just kind of coming in. So usually this is for people that have other income, right? So they've got crypto investment income or business income, sole proprietor type income, right? So they've got if you do 90% or 100% of the prior year, IRS says, okay, you've made a good faith estimate. We're not going to come back and penalize you if you were off by a little bit or owed us a little bit more. So that's an example of safe harbor. And that applies here too. So if you organize your wallets and accounts essentially, and you do this allocation of unused basis, then you basically, and you can show that to IRS. Let's say you get audited. If you can show that, there's not going to be a penalty that arises just out of the way you've tracked your crypto going forward, generally speaking. And yeah,
Okay. Yep.
I keep using these terms, and we're not like fully defining them. Yeah, unused basis. This is essentially right, like all of the cost basis. Like you've purchased tokens for $100 over here and $200 over here, or a full Bitcoin for 99,000 over here, right? You can kind of dollarize your unused basis, right? You haven't disposed of it. You're holding value of assets at the cost of them. And in my example is what, roughly $100,000 of unused basis. And then IRS uses remaining units, which we just think of as tokens, right? So in my example, I've got one Bitcoin at 99,000, and I've got some other assets at $100 here and there. Those are the remaining units that have not been sold, right? So these are tokens that I haven't sold prior to January 1st, 2025.
Okay, good stuff. Yeah, and then you mentioned a couple times here specific ID and FIFO. So specific ID is obviously just keying in on the token, right? Hey, this liquidation or spend was actually this one Bitcoin I bought at 99, so that's what I'm calling out here. And then FIFO, for those that don't know, is just first in, first out. So maybe the first Bitcoin I bought, based on the date, is what I am going to measure the cost basis of when I sold my buys according.
Exactly. Yeah, I would be remiss if I didn't go through that real quick in more detail, because I think people mess this up quite a bit. This revenue procedure does clarify that FIFO is the default approach, but by wallet and account. So first in, first out. And this is what tax softwares and crypto tax software started with as a default approach. Really, the inventory methods or inventory accounting methods is what IRS calls them. FIFO is default. And then there's something called specific ID. And specific ID, so it's really those two, right? Specific ID then has a few flavors within it. So there's kind of old school specific ID, what I call it, which is, imagine you're looking at the paper ledger, do I want to sell, sort of gold bars out of this custodian or the gold tokens I have right over in the bank? It's very much like a physical way of thinking about it, right? I'm selling these specific tokens that I purchased at this time, and now I'm disposing of them. That's pretty hard to do in crypto. So I don't think basically anybody does sort of old school spec ID, although it is an available method. IRS says that you need to really be doing that at the time of the transaction and be documenting it that way. Again, things that don't often happen in crypto. But then there's the couple of other flavors, which are last in, first out, or the highest in, first out. And those last two methods under spec ID are potentially pretty advantageous for crypto taxpayers. A lot of times, when analyzing this, we end up going with a FIFO approach. Yeah. And so like FIFO, it's looking back to a transaction, but instead of looking to the first Bitcoin you bought, just when you go to sell, instead of looking at the first, it's looking back to the Bitcoin that you bought at the highest price. And so that means that disposition, the capital gain, whether it's long-term or short-term, is going to be minimized, right? You're going to pay less capital gain tax when you use, potentially, right? Depending. Yeah. But generally across transactions, it tends to minimize this. So
yeah, that's always the kicker, right? Is long-term means anything you held for a year or more, and it's significantly more favorable tax rates. So sometimes that highest price sounds good because, hey, I bought at 99, I sold it. You're one of these people selling at 99, what was it, 600? We almost broke, and there's still that sell wall. But if that's a short-term hold, you're actually not going to have a more favorable rate. Maybe that gain's smaller, but you're at ordinary income rates versus the capital gains table, which is a lot less.
Yeah. Yeah, I think, people have probably heard enough about tax, so I think we could try and put a bow on it and just get down to like, okay, what do you really need to do? So there's really what this is looking for is a reasonable allocation, right? So this could be potentially a very difficult exercise if you've been tracking universally. If you're using a crypto tax software and you feel like that's a pretty well reconciled ledger, you definitely want to look in the settings here and look for the by wallet or by account type of setting. Not all of the softwares have it, but you want to look for that. Now, there's a huge caution flag here though, because If you do just select the button, it's really going to go change everything in history. It's not going to change just the last tax year. So this might be a point where you really do want to reach out to someone for help, because the software, while helpful, might actually completely break everything that you've done. To be specific about this, it actually can cause a really big risk, because if you don't have a locking feature where you can change the current tax year to by wallet, for instance, right, but not change everything historically, you're actually totally changing your reporting. You would have, let's say, reported crypto tax for the last 2 or 3 years, right? You showed a certain number of gains or income. If you go and change that in the tax software, now when you go to report the next year, it's working off a totally different, potentially very different ledger of those transactions and the basis, right? So you could come out with a tax return that looks great for this current year, but it's actually based on, something that is not consistent with your few prior years. And that's a potentially really big problem. Taxpayer might not even know it. They get pulled for audit, and it's like, it's all wrong, basically. So
Yeah, no, that's a key point. So it sounds like you need kind of a beginning of the year reconciliation of, all right, here's what I've done. Now here's what's left to apply the new standards to and start working
right.
off.
Yeah. And then in a practical sense, like, if you want to think about this, like, wallet hygiene is another great way to think about it. Think about like consolidating accounts, cleaning stuff up is another way to allocate this unused basis, right? Like, certainly you need a crypto tax software and ledger to like properly track all this. But let's say you've got, a bunch of Ethereum wallets, and you're not really sure, like, they don't really each have an independent purpose. If they do, then make sure that you're sort of documenting why you're using each of these, especially in a business case, right? You might have, your payroll wallet or your contractor's wallet or your income wallet or revenue wallet. Like, there's a good reason for each wallet. But on the personal side, I find that we have all these wallets, and it's like, why? Well, because I tried a different wallet software, right? Or I was using a browser wallet versus a hardware wallet. Try and consolidate these things and do a year-end cleanup. So, like, get your cold storage single address. You're going to use a MetaMask, try and consolidate it into a single or maybe a couple addresses, right? And just go through that exercise. That's a way to allocate these unused tokens, right? You're transferring them into that wallet or account. You cleaned it up. Now going forward in 25, it's going to be tracked by that wallet and account when you dispose.
Yeah, no, these are great points. And, on top of tax, right, you want to be on top of this just for crypto reasons, right? Not doing this when you absolutely have to at the last minute where maybe on-chain fees are high, right? Like, I know
Yeah,
consolidating UTXOs is definitely maybe more than annual exercise I try to look at and always suggest clients do. And same goes for ETH with gas fees. It's like, if you need to move late and you don't have to pay those, obviously that's advantageous.
exactly. Exactly. Yeah. And I think that's interesting you brought up the UTXO thing. I'll just say real quick, it is, on an EVM chain, it's much easier to think of distinct wallets, right? With the UTXO chain, because you have this natural change address, a lot of transactions can relate to a lot of different public keys, right? And this actually isn't clear. So I've discussed with some of the tax lawyers in the space and other pros. And it's interesting to see the varying understanding of what this means. I think the most fair interpretation here is that, like, you have a Bitcoin SegWit address, it's an HD wallet. Everything that's a change address is really within that wallet or account, right? If you use a Bitcoin Explorer, you search that one wallet or account, you're going to get the balance of that wallet at the time, right? Because it's pulling in all of the derivative addresses and change wallets. So I think that that's a fair way to think about it. Trying to go down to the derivative address level is like, that's total craziness. So I think it's a fair interpretation.
Yep. Good stuff. Any other final thoughts or points, key takeaways? I know we've had a great year, bull market price wise. Any other suggestions going into the end of the year for our users?
Well, outside of this, first I would just remind on the effective date. We've said it a number of times, but you get this safe harbor January 1st, 2025. It says it definitely has to be done before your first transaction in 2025. And I think if you just treat this as relatively urgent, just keep that January 1st deadline in mind. Use a little time over the holidays to do the cleanup we talked about. You're going to put yourself in a good spot. Reach out if you need any help. You can find us at the network firm. You can schedule a call right on the website directly with me, directly with the team. It's an open door. You can check the link below, download that DGens Digest, and it'll help you kind of start thinking through these issues as you prepare. But issues outside of this one, just hold on, because I think breaking the 100K mark in and of itself is just probably going to set off quite the flurry. And I think this is before we've even seen all the real good things on the ground that could happen in terms of, clarity in crypto regulation, right? Businesses, the US businesses coming back on shore to provide crypto services, and the US taking a more proactive approach to maintaining leadership and innovation in the space. So I think, yeah, it's all good times to come for the foreseeable future. That's what I would say.
Awesome.
How
Yeah,
about
no,
you?
agreed. Agreed. Yeah, I think maybe one of my other tips is, we've talked about all the rules, but just in general, right? If you did take advantage of the gains and you had to liquidate, or you spend crypto, right, for services, getting ahead of that deadline and working with someone to make sure that, hey, if I have gains and I have taxes this year and previously maybe I didn't, you definitely want to get ahead of that, because the IRS would expect some estimated tax paid ahead of the deadline, which they do apply penalties and interest to if you don't. So reaching out to talk about that's good. And then it's better now than later, because you could still take advantage of, if you have a large tax due, hey, maybe we can liquidate some losses. You could donate to charity, right, and get some tax advantages that way. So there's a lot you could do to lower that tax burden, which I know is most people's goal. So don't hesitate
Absolutely.
to reach out.
Yeah, that's a lot of good stuff. Harvesting potential losses, general year-end cleanup and anticipation. And that one you mentioned about estimated tax, right? It's this sort of non-W-2, automatically withheld type of income. IRS really expects you to be paying that as you go in the year. Frankly, I don't think a lot of people do. The higher that income becomes from trading or disposing of old assets in a very hot market, could relate to significant penalties. So yeah, let's discuss. There's strategies to make that relatively simple on a quarterly basis, making an estimated tax payment, or at least withholding, best practices for withholding, so that when it comes tax time, you're not now trying to scramble and sell assets just to get cash, which creates another tax record. It's like, yeah, so just get ahead of these things.
Yep.
Reach out anytime. Nick, thanks for the convo. This has been awesome. I really appreciate it. More TNF takes coming soon, and reach out if you need us. Thanks.
Yeah. Thanks. No. Happy Thanksgiving, everybody.
Thanksgiving.